Welcome to This Explainer. Have you ever stopped to think about what actually goes into the daily routine of a serious, high-level financial trader? What specific data points they obsess over right before the market opens, or literally the second it closes? Well, today, we are going to look at a single, highly specific request that acts as a blueprint for daily market mastery. We're going to decode it, piece by piece, to understand exactly how market data is filtered, structured, and applied. All right, let's just dive right into our source text for today. It's an incredibly specific, kind of jargon-heavy prompt anchored to a very specific future date, July 21st, 2026. Now, it might look like a messy string of acronyms at first glance, but for anyone who follows financial markets closely, this is a highly logical, completely comprehensive checklist. It demands both the broad macroeconomic picture and the intensely specific micro-level data. So how do we unpack this whole thing? Here's our game plan. We're going to start by decoding the request itself, then look at the macro picture with global sentiments and news. After that, we'll track the heavyweights, FII and DII, map out the technicals for support and resistance, and finally, dig deep into options and open interest data. Okay, kicking things off with Section 1, decoding the request, the master checklist. What's wild about this source is how the author is literally demanding a complete analytical ecosystem, all in a single breath, for that 2026 date. They don't just want one piece of the puzzle, right? They want the entire puzzle assembled. If we untangle the source, we get these 5 mandatory ingredients that have to be compiled to give a trader their ultimate edge. We've got global index sentiments, key news, FII and DII activities, support and resistance levels, and highest open interest data. A real post-market report isn't just a recap of what happened. It's about setting the stage for what is going to happen next. And to do that, you absolutely need a synthesis of multiple data streams, keeping all 5 of these pillars firmly in place. Moving right along to Section 2, macro, global sentiments and news. So we're starting at the very top of the funnel here with a big picture. The source specifically calls out global index sentiments, global activities, and key news. Listen, before you even look at a single local stock, you've got to look at the world. By requiring global activities and key news first, the report establishes the macro environment that totally dictates the day's fundamental bias. Think of this as the weather forecast for the financial markets. If global indices are crashing, or there's major negative news breaking worldwide, the local market is probably going to open in a thunderstorm. Identifying that global sentiment first gives you a foundational bias. Are we broadly bullish and optimistic today, or bearish and fearful? But here's the thing. Sentiment alone doesn't actually move prices. Capital does. Which brings us to a really vital question. Once that overarching global vibe is set, we have to figure out which institutional players are reacting to it. Who is actually deploying the billions of dollars required to push the market up or drag it down based on this news? And that brings us directly to Section 3, the heavyweights, FII and DI. To really grasp the institutional flows moving the market, we have to contrast the foreign capital, the FIIs, coming in or out, against the domestic institutions, the DIIs, moving money around from within. Guys, these are the whales. If foreign investors are yanking their money out because of that overarching global sentiment we just talked about, but domestic investors are buying the dip aggressively, you've got a massive tug of war on your hands. Tracking exactly what these 2 heavyweight groups did during the trading day is absolutely essential because it reveals where the smart, heavy money is flowing, and that sets the tone for the entire session. All right, let's get into the micro. Section 4, technicals, support and resistance. The source explicitly demands these technical markers, and for good reason. Just knowing the macro environment isn't enough to trade on. You need exact geographical boundaries for your strategy. A post-market report leverages support and resistance levels to define the strict parameters where supply and demand are practically guaranteed to collide. It dictates exactly where you enter a trade and, more importantly, exactly where you execute your risk management for the next day. Finally, we hit Section 5, options and open interest data. This is honestly the most granular, dense requirement of the whole requested report, the derivatives data. The prompt explicitly pits PE against CE, put options versus call options. This right here, this is where market participants literally put their money where their mouth is, creating this constant real-time battle between optimists and pessimists. We're looking directly at where the aggressive hedging and speculation are actively taking place. And it's such a brilliant illustration of trader psychology. Notice how the prompt didn't just ask for open interest in general, it asked for the highest open interest. Why? Because finding the highest open interest tells you exactly where the heaviest volume of market bets are clustered. Those price levels act like massive magnets. They show you exactly where the majority of traders have drawn their lines in the sand. If the highest open interest for call options is sitting at a certain price, that price will likely act as massive resistance. It's literally the ultimate crowdsourced map of market expectations. So let's just take a step back for a second and look at how all these pieces fit together. The requested data perfectly splits into macro trend indicators on one side and highly actionable price-based indicators on the other. You've got global sentiments, activities, and key news giving us the overarching trend. It's the why of the market. Then, balanced against that, FII and DII activities, support and resistance and open interest, give us the how and the where. This perfectly encapsulates why the original prompt was so brilliantly structured. It seamlessly balances the theoretical macro with the mathematical micro. By following these exact steps requested in the prompt, a trader is essentially filtering all the absolute chaos of the financial world into a structured, linear, daily strategy. You start wide with step 1, assessing the global news. Then you narrow it down in step 2 by tracking where that heavy institutional money went. And finally, in step 3, you map out the specific technical and options data to actually execute your strategy. It takes an overwhelming sea of numbers and headlines and distills it into a precise, repeatable routine. Which leaves us with a pretty fascinating thought. The specific date on this request is July 21st, 2026. Looking ahead to that, you kind of got to wonder, will technology fundamentally change how we trade by then? Or is it just going to change how fast we analyze these exact same fundamental pillars? Because whether it's today or in 2026, the necessity of understanding global sentiment, institutional flows, and price boundaries really hasn't changed. The anatomy of a perfect market report remains undeniably constant. Thank you so much for joining me on this explainer. So I have to ask, when the market opens tomorrow, is it the global news or the options data that you're going to check first?